Good afternoon, everyone, and welcome to today's presentation presented by FEI Dallas Chapter, Private Equity Portfolio Company Structures and Management Considerations. Before we begin, I'd like to review a few housekeeping notes regarding CPE credit. Today's session is worth 1.5 CPE credits. In order to be eligible for those credits, you need to answer 5 of the 6 polling questions presented on today's webinar, and also be present for 75 minutes. You will be prompted for the polls by the ringing of a bell. We will not be reading the polls today. Participants who are earning CPE credits will receive the CPE email notification in approximately 7 to 10 business days. We are unable to grant credit to CPE earners who have not fulfilled the requirements for this program. And in accordance with the standards for the National Registry of CPE Sponsors, CPE credit will be granted based on a 50-minute hour. And now I'd like to introduce Ken Wilkes, who will be introducing our speakers. But before we begin, I'd like to present a polling question.
Thank you, Nancy. We'll go ahead and get started with today's presentation. We have a couple topics on stack for today. We'll start with some tax topics, which I will not be speaking on because Lord knows you don't want that to happen. And then I'll be coming back on the back half, and we have a good panel of speakers from private equity that'll be talking about their view of portfolio company CFOs. So at this time, I'll turn it over to Lori to start the tax portion.
Thank you, Kenny. My name is Lori Mattil. I'm a tax partner with Moss Adams, and I'm just going to do a brief landscape set before we start on our structuring discussion. You know, taxpayers are still right now adjusting organizational structures and transactions to account for the TCJA that came in, you know, end of 17 into 18, and then also all of our COVID-19 guidance that we've had on the tax side. But we would be, you know, remiss if we didn't talk about the fact that Inauguration Day is less than 3 months away now. So with that in mind, you know, if there's anything the 16 election showed us is that there's no certainties when it comes to politics. So what we'll do is just kind of run through real quick what former Vice President Biden has on tap for taxes, as well as what Trump may have on tax. So if you guys will advance the slides maybe to the first slide of the presentation. Maybe one more. That's just our standard disclosure, so we can move past that. And then right there, yeah. So right now, I mean, all this slide really shows is that, you know, right now, traditionally flow-through structures are, you know, have been the easiest way to structure transactions. And, you know, with the TCJA, you saw some move over to the corporate side, but, you know, it's traditionally flow-through structures have provided somewhat of a benefit there. So next slide, please. So here's where we kind of get into the proposed transaction, or the proposed tax plans of each. And I'll just run through a few things quickly. The first is corporate tax rate. Joe Biden has said he would increase it to 28%. And there is a possibility that he would throw in a 15% minimum tax on companies' book income if they show net book income greater than 100 million. Trump has said that he favors a decrease to 20% on the corporate rate, but no formal proposal on that yet. Depreciation, there's no specific proposal by Biden on that, on our bonus depreciation, but with a 15% minimum tax potential, that may play less now. You know, it could be affected by that. Statements by Trump indicate that he may want to expand or, you know, extend bonus depreciation. Next slide, please. Individuals would are right now at a top rate of 37% through 2025. President Trump has said, you know, his budget blueprints assume a permanent extension of that, but there's no formal proposal. Biden wants to restore the top rate of 39.6. With regard to capital gains, Trump has expressed an interest, you know, in capital gains relief, but again, no formal proposals there. And then tax on long-term capital gains and dividends would go to ordinary rates under Biden's tax proposal for those with taxable income of greater than $1 million. So, you know, we're seeing tax rate increases across the board here. So next slide, please. Carried interest, which I know is always a topic in the private equity realm. Trump has indicated, you know, that he wants to end the favorable treatment on carried interest, but there's been no formal proposal on that. Joe Biden would also tax carried interest at the ordinary rates. You know, the TCJA brought in the long-term capital gain hold longer than 3 years instead of the 1 year mark. So, you know, we'll see what plays out there. And then pass-through income, you know, with regard to the TCJA, we got, because of the reduction in the corporate rates, to keep flow-throughs, you know, tax beneficial, we got this 199 cap A deduction that gives you a 20% deduction on qualified income from pass-through. It's unclear if President Trump intends to make that permanent. Right now it's set to expire in 2025. Biden, you know, he has said he will phase that out for tax filers with taxable income greater than 400,000. So, you know, again, right now, TCJA's reduction of the corporate rate from 35 to 21%, it decreased the incentive to structure tax deferred transactions. Mr. Biden's proposed rate increases could cause that pendulum to swing back the other direction, increasing the desirability of tax deferred reorganizations and other transactions. So just wanted to kind of set that landscape. So now I think I'm going to turn it over to Harry, who is going to go through some of the considerations on the acquisition side of looking at these transactions. Harry?
Yeah, I think there's a polling question, but I can certainly speak while people respond to the polling question. If we can go to slide 11, we can begin on the tax structuring considerations. The next slide, please. Wrong way. Well, as we get to that slide, what I intend to do during this discussion is talk about the basic forms of a transaction, the results to expect from the transaction, and the reasons for a particular form of a transaction. And then also discuss the issues to consider when negotiating the form, and then ways to optimize the transaction. And assuming timing permits, we can also discuss some of the common pitfalls or traps for the unwary in the transaction. So to begin with on this slide, obviously there's two forms of transaction, either a stock deal or an asset deal. And the question is, well, which one is more favorable? Obviously, for sellers, they want to do a stock deal, and buyers want to do an asset deal. Primarily, the reason for a stock deal on the seller's behalf is because they want to remove themselves from any post-close liability and move it over to the buyers. And then an asset deal is kind of the converse, where the buyer wants to get a step up in basis and also limit their liability for any pre-closing tax liabilities. And we'll get more into that as we talk about the different forms of the structure. On the entity of the classification of the target, depends on how you can either result in an asset deal or stock deal. There's different forms of classification, including a C corporation, an S corporation, and a partnership or disregarded an entity. An LLC is kind of can be a mixed bag of things, and it depends on either its default form, which is a disregarded entity if it's a single member, or a partnership if it has more than one member. And of course, you can make an election to treat it as a C corporation if desired. Depending on the form of the transaction, it can be taxable or tax-free to sellers, which is generally depending on the type of consideration. Generally, in any deal, when a seller receives cash, they're going to be taxed at least on the cash component on the transaction. And if there's not enough equity in the deal and it's mostly cash, then even in some rollover, the transaction can be fully taxable. The next part of the transaction structuring is that in some cases, you can structure a stock acquisition for legal purposes and treat it as an asset acquisition for tax purposes. We'll get into a little bit more of the nuances on that, but generally that's limited to two types of targets, either a C corporation that's a member of a consolidated return group or an S corporation. And the benefits, again, is that you get to keep the legal structure of the deal as a stock deal, and that helps for commercial reasons on transferring assets or contracts where it may not be feasible in a legal form asset acquisition. The next consideration is if you have a large footprint with a more than one entity in a consolidated group or a worldwide group, the question is where do you place the target to optimize the tax supply chain in order to maximize tax efficiency and maximize after cash taxes. And so, for example, if you have a consolidated group and it's domestic, if you were buying an entity, do you want to keep that entity in place, and so you can broaden your footprint in order to minimize state taxes? And similarly, if you are a worldwide group, where do you put the target if it's foreign or domestic? What you don't want to do is have a sandwich structure where you have either an international company sandwiched between two U.S. companies or vice versa. Pulling the profits or distributions up the chain in and out of different countries can attract withholding taxes or other domestic taxes as you try to get cash out of the corporation. And so where you put the target in the transaction also is something to be considered. Future tax cash analysis. This helps with when you're valuing a transaction, such as a discounted cash flow model. What you want to do is start generally with your EBITDA and then make adjustments for all your significant book tax differences, primarily your depreciation, amortization, and also your interest deductions. As a result of legislation in 2017, we saw significant restrictions on issuing debt and limitations on interest deduction. And also you want to be careful about what you're plugging in for your tax rate. Generally, I see in cases a model from a buyer where they're plugging in a marginal rate or 30% or something that they pull from a different model, not thinking about the particulars, either if there is a cash leakage as a result of having a foreign structure, or also for state taxes where you have to add to the marginal federal rate, the blended rate for state taxes. So that's another area to look out for when modeling future cash taxes. We'll get into more over on seller's rollover, but generally in deals, you want to optimize the structure to provide the rollover for the seller tax deferred treatment if possible. And then, as we just talked about, there are issues on limitations on deductions for interest, particularly as a result of the TCJA in 17. There's the new code section or updated code section 123J, which basically provides a deduction of 50% of EBITDA and then moving towards 30% EBITDA. But as a result of the pandemic, they've extended 50% for at least another 2 years. And then I think when we move to Todd, he'll talk about some exit strategies. So moving on to the finer details of these points. The next slide, please. The form of the acquisition may dictate the results. And so in an asset acquisition, you can structure it either as a legal form where you buy assets. You could also structure it by way of a merger. As a forward merger is automatically treated as a taxable stock acquisition. And then as we move into stock acquisitions, there's also ways to treat that again as an asset acquisition with either a Section 338 or Section 336E election, depending on the form or the classification of the buyer. Again, another stock acquisition you see mostly as a result of corporate law in order to get a favorable vote to move forward with the merger. You'll see a subsidiary reverse cash merger, which is also treated as a stock acquisition. Again, we talked about different types of mergers, the forward merger and the reverse merger, and how they are treated as an asset or a stock acquisition, respectively. And then you also see a lot of joint ventures where the parties will contribute their assets to a new entity. And in most cases, assuming there's control and other requirements are met, you can get tax deferred treatment for the rollover on the sellers. The next slide, please. And so thinking about the taxes imposed on the transaction, obviously, if you're going to have a taxable stock or asset transaction, you're you're going to pay taxes on the built-in gain, the measure between your basis and the consideration received. There's also indirect taxes that need to be negotiated, such as sales and use tax if you have an asset deal. Sometimes that can be avoided or mitigated as a result of having a bulk sale exemption or other one-time exemptions when you're buying a trade or business. Also, it's important to think about in the contract when you're doing a transaction to negotiate those kind of taxes so that you're not stuck on the backside of a transaction trying to negotiate things without protection. Generally, I see parties split sales tax 50-50. That way, each party is motivated to either pay or file the form depending on the party post-close. Business versus non-business income, that generally involves an asset deal where you're trying to mitigate ordinary income or the cash taxes from ordinary income. Generally, when you sell an asset, it's going to be capital gains, stock or assets, except in the case when you have recapture or hot assets like inventory that are less or that are greater than the basis of the seller. And those items such as inventory or to the extent the gain equals or exceeds the depreciation that was recognized on that property being sold, that can be ordinary income. And so generally capital gains rates are 20% and ordinary income at the highest marginal rate is 37%. However, non-business versus business income goes to the new Section 109 Cap A for qualified business income, which if the sellers materially participate in the business, they can reduce their marginal rate of ordinary income from 37% to 29.6%. And that's a common negotiated point too, because the sellers are going to be sensitive to amount of consideration allocated to ordinary income assets. Again, you have on an asset deal, you can have real estate transfer taxes, and the same taxes can be imposed on a stock acquisition, assuming there's a controlling interest in the sale. Most states define a controlling interest on property and lease property if there's a 39-year lease on the property. And so those can pop up unexpected if they're not looked into. And again, on international taxes, unlike the US, some jurisdictions have stamp duty tax or other taxes that are imposed on the transfer of shares. And so those are the things to think about when negotiating a deal and the taxes that could be triggered as a result of the transaction. And moving to the next slide. So in a taxable asset transaction, as I said, the gain is measured between the consideration received and the basis and the property being sold. Consideration equals not only the purchase price, but also the liabilities being assumed and the capitalized transaction costs. When considering the liabilities, there could be contingent liabilities. Generally, it's a very nuanced approach, but generally speaking, if a liability is contingent and it's triggered post-close, but arises in connection with pre-closing obligations, generally it's going to be capitalized and into the basis of the assets acquired. If it's triggered post-close and relates to operations post-close, it can be then considered deductible under 162. And so looking at those contingent liabilities is also strategic thinking about what your basis is going to be in, or your gain is going to be in the transaction. There's also installment sales. So anytime that the seller is going to receive one or more payments after the close of the taxable year, they're going to be subject to the installment sales unless they elect out, which is basically your gross profit percentage times the total gain being recognized on the amount of consideration that's going to be paid each year. Generally, transactions under $5 million won't be subject to an interest charge, but transactions where there's more than $5 million in gain are going to be subject to an interest charge on the deferral related to the installment sales. The other thing to consider in doing an asset sale is generally you won't see an asset sale and the sale of a C corporation because it's subject to 2 layers of tax, meaning that when the consideration comes into the corporation, it's going to pay tax. And then on the distribution and liquidation of the company to get the consideration of the proceeds to the sellers, there's going to be another tax on their stock. And so normally, unless the corporation has built-in losses or it has enough NOLs to offset its gain, they're not going to do an asset transaction. But unless it's an S corporation or C corporations for the reasons I said before, if it's eligible for Section 338 H10 election. In a partnership though, it's going to automatically treat it as an asset deal if it's sold at 100%, or if you buy interest in a partnership, it's going to be treated as a sale of interest, but it's subject to capital and ordinary income, again, for those hot assets like inventory, if the basis is less than the fair market value, or again, recapture and depreciation, assuming that the gain on the property and equipment exceeds the amount of depreciation that was claimed on that property. From a buyer standpoint, obviously they're going to get a step up equal to fair market value. They're not going to acquire any attributes like NOLs. None of the accounting methods are going to follow, so you get to adopt new accounting methods. And again, it may cost some transfer fees to the extent you don't qualify for an exception or there's real estate transfer taxes. But we'll get into more of the consideration or the nuances on an asset acquisition that provides some tension between buyers and sellers. But moving on into an asset acquisition on the next slide, please. Thank you. Comes to basis. We talked about basis is going to be equal to your consideration exchange, which again is the purchase price plus liability assumed and the capitalized transaction costs. Contingent consideration like an earnout, assuming it's not considered compensation and is considered purchase price consideration, that gets added to basis when paid. And then you have your purchase price allocation and what's reported to the IRS. And here's where some of the tension comes in with buyers and sellers. And so on the next page, we see the residual method that's required by the tax code for allocating basis. And if we could go to that next slide, please, we can just illustrate the different classes that follow the residual method. Generally speaking, class 1 through 4 are not going to have a lot of tension in it, assuming that the seller was on the accrual basis. If it's on the cash basis method of accounting, then accounts receivable will have no basis, and that's going to result in ordinary income to the seller rather than capital gain that's expected. Same thing of inventory. If it was written down for tax, but the fair value exceeds that basis, it's going to be also ordinary income on that gain. But where the tension normally lies is on class 5 for your property, plant, and equipment. Again, generally it's capital gain, but to the extent the gain is going to exceed the amount, the depreciation that was taken on those assets, that's going to convert the capital gain into ordinary income. And so you see a lot of tension about purchase price allocation, about how much consideration to allocate to class 5. Class 6 and class 7 generally have always been capital gain, but in connection with the Tax Act in 2017, they changed the character for certain IP. Generally speaking, if a founder was to contribute IP to the target, and then that's sold, that built-in gain will be treated as ordinary income rather than capital gain. However, if you can demonstrate that IP was developed by the employees acting in the capacity of the company's benefit, then it will maintain its character as capital gain. And so you want to be sensitive about those kind of things between buyers and sellers. You can be aggressive on the sell side and try to allocate tax basis to inventory. To PP&E and avoid this recapture. Or you can be aggressive on the buy side and try to get fair value or at least net book value on those assets to get some basis step up, because until 2022, 100% bonus depreciation is available for the tangible property that's less than 20 years. Generally speaking, in the tax code, the courts will accept any allocation among buyers and sellers because nobody demonstrates fair market value than two unrelated third parties. But you got to be careful on how aggressive you are, because the service may see it as opportunistic based on the tax profile of each party and challenge if you're too aggressive one way or the other. So kind of be careful about those kind of things. And then again, as a result of changes in 2017, class 6 used to be always cap gain, but now with respect to IP, certain IP can be ordinary income. And so some sellers are thrown off by that because they're not thinking about it. And when you have rollover and you have unexpected consequences post-close, what you don't want to have is frustrated sellers who are still running the business and can make for an unfavorable environment. So let's move on to the next slide. And we'll talk about taxable stock transactions. In this case, generally speaking, without an election, you won't get tax basis step up, it'll be carryover. But all attributes will carry over because including NOLs. Now, there may be a limitation to the NOLs. under Section 382 or other limitations under the tax code that can preclude you from benefiting from all those NOLs. And so that should go into the modeling as well if there is a discounted cash flow. With respect to basis, again, it's going to be carryover. However, as I mentioned before, if you're buying an S corporation or a member of a consolidated group, you can make an election depending on what classification the buyer is under Section 338H10 or Section 336E, which will change for tax purposes only a stock transaction to an asset transaction. Let's move forward in sensitive of time. Again, when does it make sense? It's only available when you have a consolidated member of a consolidated group or an S corporation. What you want to be careful though is if there's rollover, let's say in the S corporation, it does make sense to make a Section 338H10 election only in the case when you're buying 100%. If you're buying less than 100% and you're trying to roll over some of the stock, a 338H10 is going to trigger all of the built-in gain, despite that some of it may be rolled over tax-free or intended to be tax-free. And so you want to think about optimizing the structure so that the rollover can be as intended to be tax-free. If you have a S corporation that's been formed or received property in a non-taxable transaction within 5 years of the election to treat it as an asset acquisition today, the IRS will ignore the election and treat it as if it was a C corp and tax the built-in gain that existed on the conversion to an S corp. And so that's another trap for the unwary, that it's not a foregone conclusion that there's one level of tax in S corporation. If there is built-in gain with the 5-year period of the selling the S corp stock, that built-in gain is going to be taxable at any level, like similar to a C corp. And so that's one of the traps for the unwary when purchasing S corp stock. Moving forward to the next trend. So here we have a little bit of discussion on what are the proceeds and the intent. Again, when thinking about rollover, as I mentioned, if you're doing an S corporation and you want to get a step up on the H10 election, that's a bad idea because you're going to trigger all of the gain despite the rollover. So there's different ways to structure that deal. So for example, a common approach that's been around or blessed by the IRS since 2008 is to restructure an S corporation into an LLC pursuant to what's referred to as an FEI organization. That FEI organization will be tax deferred to the sellers and will result in a single member LLC being the target, which as mentioned before is treated as an asset deal. And so if the buyer buys 100% or less of that LLC, it's treated as an asset deal. And what's not purchased and maintained by the sellers is not going to be taxable until the sellers dispose of those shares. And that's one of the typical structures you see in order to preserve a tax-free treatment on a rollover. Some things to consider when you're issuing seller notes as consideration for a deal. It's going to result in an installment sale if the payments extend beyond the taxable year of close. And so, for example, let's go back to the case where you have an S corp selling an LLC pursuant to the FEI work to maintain the tax deferred and the rollover shares. Well, if the S corp is the seller of those LLC interests and it receives a note, but you want to get the proceeds to the sellers and you liquidate the S corporation, what was intended to be an installment sale because you received a note with a payment beyond the taxable year, it could automatically accelerate that installment note and trigger all the gain on year one, which is an unintended consequence. Something to think about. Again, earnouts is another way to defer and defer gain and also manage valuation if there's a dispute in the value of the company. Earnouts should be considered. They should be defined as so in the contract to avoid the IRS challenging the character of an earnout as compensation. We've seen that issue before. And so it should be clear in the contract how the earnout is expected to be taxed. And again, an earnout doesn't result in basis until paid, and it's not taxed until paid. Similarly, an escrow is also going to be considered paid and at resultant basis when released. And then there's purchase price adjustments such as working capital that are intended to affect purchase price. And so if there is a net working capital adjustment or there is an adjustment from an escrow being paid. All of that is intended to be a purchase price adjustment going to the basis of either the stock received or the assets transferred. So the next slide, please. And I think over here, we'll hand it over to Todd to talk about the exit considerations on the back end of a deal.
Yeah, hi, this is Todd Way. I am based in Dallas and a tax partner at Vincent & Elkins. I'm going to talk about exit considerations for flow-through portfolio companies. Next slide, please. Okay, so this diagram shows a common, albeit simplified, flow-through portfolio company structure, where normally the portfolio company itself is classified as a partnership for tax purposes, and there's typically a lower tier asset holdco that's classified as a disregarded entity for tax purposes. So keep this in mind as we're going through the alternatives. Next slide, please. Okay, so on the structuring alternatives, when you are structuring the sale of a flow-through portfolio company, you normally have three primary alternatives. One, the equity holders, which would be the PE fund and the management team, sell their equity interest in the portfolio company. The second alternative is the portfolio company sells its equity interest in Holdco. And the third alternative is Holdco sells the assets directly. So let's go through and compare each of these alternatives. Next slide, please. So alternative one, equity holders sell and transfer their equity interest in the portfolio company. A sale of the upper tier portfolio company is generally treated as a sale of partnership interest from the seller's perspective from federal income tax purpose. So generally a sale of a capital asset. So the structure normally results in capital gain or loss, except to the extent attributable to depreciation recapture and certain other items that are treated as ordinary income items under Section 751 of the code. And this is something that Harry touched on earlier in the presentation. The fund GP under this alternative is generally going to be subject to the carried interest rules on its allocable share of the income attributable to its carried interest in the fund. The carried interest rules are fairly complicated. We don't have time to get into all of the nuances of those rules, but it's worth providing a short summary. I think that Lori mentioned briefly that generally, if you have a capital asset and you've held it for more than 1 year, it's treated as long-term capital gain when you sell it, which is subject to the favorable 20% maximum rate under current law. But if you're subject to the carried interest rules under current law, you have to hold the property for more than 3 years in order to get that beneficial rate. If you've only held it for 1 year, you're going to be generally subject to the maximum 37% ordinary tax rates. Another feature of this structure is that management may be able to roll over some or all of their interests to the buyer in a tax deferred manner, basically by contributing their interest in the portfolio company to the buyer in exchange for an equity interest in the buyer. This is fairly simple if the buyer is classified as a partnership for tax purposes. It's a bit more complicated and often not doable from a practical perspective if the buyer is a corporation. So that's something that you'd have to take a look at. This alternative generally is treated as an asset purchase by the buyer for federal income tax purposes, except of course to the extent that there's any tax deferred management rollover. So generally the buyer would get a stepped up tax basis if it acquires 100% of the partnership interest. The sale of an entity is normally not subject to transfer and sales taxes in most jurisdictions, but there are exceptions so you should look into that, talk to your tax advisors, just depending on what jurisdiction that you're in. There are some jurisdictions like Pennsylvania, for example, if you're transferring real property, that will look through and potentially hit you with transfer taxes, even if you're selling an entity. Next slide, please. The second alternative is for the portfolio company to sell its equity interest in Holdco, which we're assuming here is classified as a disregarded entity for tax purposes. This structure is generally treated as a sale by the portfolio company or a sale by the portfolio company of the assets held by the Holdco to the buyer for federal income tax purposes. So any net gain on depreciable assets in real property that's used in a trade or business and held for more than 1 year is 1231 properties. That's what I'll call that, and generally qualifies for long-term capital gains rates, except to the extent of course, recapture. And net loss on such properties is generally qualifies for ordinary loss treatment. Note that gain on 1231 properties is not subject to the carried interest rules because those rules only apply to capital assets, not 1231 assets. Thus, it's possible that this structure will provide a more tax efficient result for the fund GP without negatively affecting the limited partners. However, it's very fact dependent, so you really want to get with your tax advisors and model it out. Normally, tax rules apply to capital gains in this structure, just the normal rules. So in other words, if a goodwill has been held for more than 1 year, the gain's normally treated as long-term capital gain to the individual partners. For the fund GP, the holding period will likely be 3 years for capital assets under the carried interest rules. And as noted above, the carried interest rules don't apply to the 1231 gains on the sale of hard assets. So the purchase price allocation that Harry talked about earlier is going to be relevant to this type of analysis. There could be a tension not only between the buyer and the seller in terms of how they want to allocate the purchase price, but there could be a tension between the management or the fund GP and the other partners in certain circumstances. One negative alternative is that it's more difficult for management to engage in a tax deferred rollover in this structure because the portfolio company is the seller and the management team is simply allocated its share of the income that the seller generates as a result of the transaction. You don't have assets that are directly held by management that they can contribute to the buyer in exchange for equity in the buyer. And normally, just like the prior alternative, when you're selling an entity, even if it's a disregarded entity in many jurisdictions, that's not going to be subject to sales or transfer taxes. But again, there are exceptions to that. So you need to look at the specific jurisdictions that you're dealing with. Next slide, please. The third alternative is for a holdco to sell the assets just directly. And you're going to have essentially the same federal income tax consequences under this alternative as described in alternative 2, where the portfolio company is selling a disregarded entity, except that here, the tangible personal property, and in some jurisdictions, even real property, is generally subject to transfer taxes unless you have an occasional sale exemption or some other exemption that's available. And there's also certain scenarios in certain jurisdictions where it's potentially less favorable from a state income tax perspective to sell the assets directly. For example, in Oklahoma, if you sell assets, the income's going to generally be apportioned to Oklahoma. If you're selling an entity, especially if it's classified as a partnership for tax purposes, that can be apportioned outside of Oklahoma. And you have also a rule in Texas where if you're selling assets, it's going to generally be that are located in Texas, you're going to have gain apportioned to Texas. If you're selling an entity and the buyer is not organized in Texas, then generally that income would be sourced outside of Texas. So that's something to factor in as well. The key takeaway, I think, from looking at these alternatives is that different structures can lead to materially different results, depending on the factual circumstances that you're faced with and depending on the players. So you really have to model this out. There's really not a bright line sort of test that you can apply in every scenario. You really have to get with your advisors, have them model out, what does this look like if we sell our portfolio company? What does that mean for our LP investors? What does that mean for the GP of the fund? What does that mean for the management team if they're wanting to roll over? And really look at the pros and cons of each of those potential alternative structures and figure out kind of what's the Nash equilibrium. Generally, the buyer's not going to care. The buyer is normally, from a tax perspective, going to get a basis step up in either event when you're talking about flow-through entities. So it's really the pressure is on the different players on the sales side. Sometimes the LPs, it'll be more favorable to use one structure. A GP, because of the carried interest rules, may favor a different structure. And of course, management, if they want to roll over, they may have a different view as well. So you really have to model them out, see when it matters, see when it, when it doesn't. And when you have competing interests, get together with the parties and decide what makes the most sense for everybody. What's the Nash equilibrium? And that concludes my piece of the presentation. I don't know if we're going to pass it back to Lori or to Harry to talk about some of the potential problems that can occur.
Thanks, Todd. That was great. In the interest of time, I know we want to get on to the panel. So you guys have the materials, or you will after the presentation. So, you know, we'll let you read through those, and our contact info as well as Todd's is all at the back of the presentation. You know, questions come up, feel free to reach out to any of us. So Kenny, I think we'll turn it back over to you.
So I appreciate that. Thank you, Todd and Lori and Harry. I know Lori and some of us may stay in some of the breakout rooms afterwards for any additional questions. I know there's a networking event after this and also at the panel. What I'd like to do is, while we're introducing the panel, if Nancy could load the next polling question, so we hopefully get everyone a chance to offer that. And this is just to give our panel speakers an idea of what industries everyone participates in. But really, our topic is for the next half hour is really not nearly as technical as taxes, moving into more of the softer skills and some of the other things we deal with. And that is looking at the view of a portfolio company CFO from the viewpoint of professionals that are working in the private equity side. And so we have James and Lou and Jerry here with us today, representing a variety of different private equity backgrounds. And even within their group, they're representing different pieces of that private equity puzzle. And so if Nancy could show the results from the last polling question, I don't know if we can do that or not. And while those results are being shown, why don't I go ahead and start with Lou and see if you do introductions, and then work our way through Jerry and then James.
Sure. Good afternoon, everyone, and thank you for the invitation. I have founded and manage a private equity shop named Juniper Capital Management. Our focus is principally industrial service, infrastructure, manufacturing companies. We have 3 platforms and own 5 companies. Have worked through the pandemic situation relatively in stable shape, and we're involved in a number of target LOIs at the moment to both add to these platforms plus create a new platform. I have been in this business for 5 years. My career before that was through professional services. Happy to be with you all today.
Thank you, Lou. Jerry?
Great. Thanks. Glad to be here. I spent a better part of 25 plus years, not in the private equity side, but mostly in the technology side, both for VC-backed companies, private equity-backed companies, as well as public companies. Most recently here for the last 3.5 years, I've been with the group by the name of Marlin Equity. We've done over 120 transactions. Today, roughly $7.5 billion plus under management. And I am an operating partner, therefore sit on 4 of our 40-some companies' boards.
And James?
Yeah, thanks, Kenny. James Long here. I'm a principal with Aura Partners. We are a $400 million first-time private equity fund that is focused on the decarbonization of the industrial sector. We are looking to find businesses both in the lower middle market as well as the middle market in the industrial, chemical, specialty materials, food, agriculture, and power sectors. I've been in the private equity business pretty much my whole career. I was at First Reserve, which is a mega buyout energy private equity fund for about 10 years before I came here to join Aura a couple years ago.
Thank you all. And thank you all for taking your time to join us today. We're just going to go ahead and start from the very front. Kind of the first question is on the front end of a private equity investment. How important is for that management team to have a CFO in place before they come to the private equity fund? And does the answer change if you just have a strong controller? Can you provide some guidance on that? James, do you want to go ahead and start us out?
Yeah, sure. I think the answer to that question is it really depends. One, it depends on the CEO and the specific strategy that's being pursued and their capabilities. I would say at our private equity shop, we do both traditional private equity businesses that already have cash flow that are already up and running. That's about half of our business. And the other half of our business is what we call industrial growth, where we're actually starting up a business for the first time using a technology and going out and building a plant for the first time. So for the traditional private equity businesses, it's very important to us that we at least have a controller in place to be able to account for the historical operations of the business and account for the business properly. From an accounting perspective going forward, I would say that's an absolute requirement on our end. And as those businesses progress towards exit, we do like to have a strong, more financial minded CFO that can drive value creation and really pitch the business, and also to think through financial engineering to think about any value uplift that we can generate there. For our industrial growth businesses, we have a strong CEO. It's less important for us to have that CFO in place on day one. And it's more important for us to really figure out the operations of the business to be able to ramp up at the beginning to start building that plant. And before there's actually cash flows, revenues that we're generating, we actually don't need to have that person in place on day one.
That kind of focusing on the private equity side of that. Nancy, if you go ahead and launch this next polling question, also to give everyone a heads up on the polling. This is more just one of those factoids. I did some research on what makes up the typical CFO, whether they have CPAs or a finance background. Just a trick question, just everyone's guess once we do it. But that leaves you, kind of as James was mentioning, in the more traditional private equity background of having your CFO be more of a accounting operations role or more of a finance fundraising role. And what do you prefer to have at your portfolio company level? And are there different situations that one type of CFO is better than the other? Lou, on your funds, where do you see what type of role is a better fit?
Again, back to James's initial comment, it does depend. Our companies are what I would consider middle to lower middle market companies that have cash flow EBITDA level from 3 to 7, probably when we buy them. They already have some level of success, but that level of success is driven by the president, CEO, founder of the company, and their team. And it has a accounting finance element that frankly is adequate for that level of company. But when you consider scaling and having an investor base and having external third party involvement, then you have to do a couple of things. One is really strengthen the infrastructure platform, and then to James's point, add value along the way. And so that, specifically to your question, would lead to a controller, operations person that can certainly understand finance or accounting and do the financial reporting on a monthly basis on a timely and accurate manner. And then also strengthen the platform by driving a systems basis, an administrative basis, and a control basis that strengthens things. And the thing that the aspect that we look for in that controller relative to the finance world is to be able to communicate effectively with our banking partner who is involved in each of our deals and manage that relationship. But we, as the GP and the manager of the investment overall for investment have a finance dimension in it that helps on the financial side, and to the extent additional capital is required, we would drive that process.
Very good. Jerry, across your 4 companies you operate with and the big operations team you guys have, does that answer change as you go up the scale?
Yeah, I mean, it definitely does. I mean, I think regardless, I mean, we have portfolio companies that are billion down to 20 million. And I think what we look at, it's what's our investment thesis? And if that investment thesis is around growth, is it around EBITDA? Is it around M&A, or is it an IPO? Is it identifying within that life cycle, that investment thesis on what do we have, right? Both from a controller and a CFO. And a lot of times we'll identify that even prior to acquiring the company, or there shortly after, and determine if we have, if we have the right team in place. So I think, just as Lou said, or James has said, it's going to be different for every portfolio, and based on your thesis and what you're trying to accomplish, and identifying the skill set that you have. Because a lot of the time, especially depends on your whole period. If the whole period is 3 to 5 years, there's not a lot of time to to do a lot of training.
Right. Exactly. That 3 to 5 years goes by very, very fast, and we've seen that transpire. And along that, in that kind of fast-paced environment, I know Lou made a reference to communicating with the bankers, but then moving on to that communication between the portfolio company and the private equity group. How often do you like to hear from your CFOs? How active are you involved, and what information do you like to, what specific stats or types of information do you see that's really beneficial versus some other times you get some information that may not be as beneficial? And we can go ahead back and start back with James and hear what you say.
Yeah, I think generally I prefer as much communication with our CFOs as possible. And I typically find, going back to your first question on an accounting-oriented CFO versus a financial-oriented CFO, I've managed probably 30 portfolio companies over my career. And typically what I find is I communicate a lot more often with our financial-oriented CFOs. And that's just because with those businesses, often there's just a lot going on with respect to growth, both organic as well as M&A. You're involved with one business that we acquired 18 months ago, and since then we've subsequently acquired 8 additional new follow-on companies over the past 18 months. And so between me and the CFO there, I mean, he's literally emailing me multiple times per day. We're calling each other out of the blue just to talk about things that are going on. Maybe he had a conversation with a potential acquisition target, and it's just good to catch up as soon as after he has that conversation to see, like, hey, what did you think about that business, and how should we approach this acquisition going forward? I find typically from the accounting CFOs for those businesses where we don't have a financial oriented CFO, those businesses are typically already more stable and mature, and just not a lot of activity kind of going on within those businesses. And so typically what I find there is we're usually communicating on a scheduled basis, where maybe it's a bi-weekly call for a couple weeks, where they're reporting on just the general financial statistics of the company. What happened last month, any surprises, any variances to what was in our budget, and which is fine. I think it just depends on the situation that each particular portfolio company is in, is what dictates the optimal communication levels between us.
And Lou and Jerry, on any of that, do you guys have systems set up within your portfolio groups to facilitate that communication? Do either of you have any comments or things you've seen best practices in that regard?
Well, yeah, our model's a bit different, I think to a certain extent unique, but I think we're all unique in our own way. But as it relates to a systemic aspect, we, at the very beginning of a deal and depending upon the business thesis that's been referred to, we establish a financial reporting package because generally the company doesn't have one, or it doesn't have one that is a regular process that leads to ultimately an analysis and understanding. We establish that with the leader and the finance accounting function, and try to identify the drivers of the business and develop a financial reporting package that provides insight into the numbers as well as the numbers, and not overdoes it with just information and data that really makes it very difficult to digest. And then we have a monthly conversation with the team, including the finance, accounting, controller, but we look to the leadership of the portfolio company to drive that discussion. And we view the accounting, CFO, controller role as a partner with the leadership. We generally do not go direct to the finance person. We could, and we do if necessary, but we try to work through the leadership team there versus directly to that dimension. And so I would say that probably is the approach that we've taken to our deals.
Jerry, is there anything different with your organization?
No, I mean, we get pretty prescriptive. I mean, the communication, our biweekly meetings with the CFO and CEO, basically that are 7 or 8 kind of top questions that are driving the business. From there, there's weekly reporting backs, monthly reporting backs, quarterly reporting backs, and if you talk to some of them, they'd say they have to hire a separate FP&A just to keep up with our reporting. However, that being said, we try to automate it, right? Where it's you can click on a button that's coming out of NetSuite or your adaptive implementation. I mean, the most important things are going to be is always your 13-week cash flow statement. See if we're on plan. As it relates to what we really try to drive it to is quarterly business reviews. So we're usually about a 4-hour meeting, changed now a little bit, but mostly in person, that we're identifying our investment thesis against our 3-year strategy and the KPIs to support. And a lot of times with that CFO, they're responsible to educate us on how we're doing on the KPIs. So a lot what James has said and Louis said also.
Yeah, and I bet a lot of the new CFOs and new controllers, when they get on that rhythm, find it a little bit overwhelming. One of the things I find interesting, I've seen a variety of different situations between private equity groups. Within your shop, do you encourage the CFOs from one portfolio company to reach out and contact other CFOs and other portfolio companies? What level of communication do you have between your portfolio companies? And what do you do to help encourage some of that communication to best, help leverage off the different teams? Jared, do you want to go and start on that one?
Yeah, I mean, as of about now 2.5 years ago, we formalized it. So before it was up to each operating partner like myself to determine what kind of level of communication I want between the portfolios. But we standardize it at least within funds because the fund is really representing the size of company, which dictates the type of CFO that's associated with it. But today we have usually every 6 months a structured 1.5-day meeting that has the topics at hand that are really coming from our CFOs. And what we try to do is bring in best practices from each of those CFOs where we believe they've done a good job at an individual topic, or we'll bring in a third party to discuss it. And as a result of that, that naturally brings CFOs together to be able to establish a relationship and chat with each other.
Okay. Lou or James, anything you guys do with your shops?
Yeah, I mean, I'll just hit on something Jerry said earlier about just establishing a formal kind of template for the whole reporting process. We definitely have a very strict template here at ARA that if the day we close on any investment of a portfolio company, we send that whole template of, hey, here's what we need every week. Initially, is we need a call every week, every 2 weeks, what we need to see from the financials every month, what we need to see every quarter, and on an annual basis. So we're definitely professionalizing that process and in the process of doing that here at ARA still. At my old firm at First Reserve, we actually had an even more strict process of where once a year we actually just have an entire offsite for the management teams of all of our portfolio companies. Pick a location in the world, bring everyone there. And that was actually bringing people together, which is something we're unfortunately not able to do in this year's environment. But back then, when we were able to do that, what you would find is, you have the full management teams there. The CFOs would tend to, go off and talk to the other CFOs and just share ideas about best practices and what they're implementing at their companies, both in terms of processes as well as systems implementation, as well as the best ways to think about growth and driving strategic direction in their particular businesses.
Very good.
Right now in our evolution, we're at the beginnings of that. We are the facilitator of those discussions and sharings because there's a vast difference in process and activities across our portfolio. We probably spend more time engaging the leaders and CEOs across our companies with each other from a strategic standpoint, less in the finance and administrative areas, although we have done that. I think what our objective would be would move to what James described, to actually bring the teams together, because there's certainly, if you can do this in a practicable way and focus on topics and not overdo it, there's a lot of benefit to be had here.
Right. And I think you guys focus, it's evident that you look to your management team, the CEO, the leaders of the organization to drive growth. Us accountants in the back room don't always are seen as a growth driver, just seen as overhead. I just like to hear from you guys if you guys have had an experience where a CFO has done something that really contributed to the overall growth on the front end of a company. Maybe some success stories where a CFO drove something.
Kenny, I'll take that one initially, if it's okay, because having spent a better part of my career on the audit side, what always bothered me was the potential insinuation or the implication that there's two classes within an organization: a support group and a growth group, which include the CEO and the COO, which is totally false in my experience. What the finance function and the CFO role and the controller role has always done and should be looked to as a huge enabler to growth, because if you do that right, you will support growth and drive growth in many different ways, least of which is getting the information correct and right and with insight into the information, so you don't distract the whole organization. Because when you have a problem in the finance area, the whole organization gets turned toward that problem, and it distracts the whole situation. And it doesn't matter if it's a small company or a large company. So the finance, accounting, control function is particularly important, and it's actually where all information has to go through, because everything requires capital, and you need that perspective when you make any decision in a company, because it is the language of business, basically. Now, I don't want to overdo it here, but it dispels this whole myth that we've got a support group that isn't necessarily looked to add value. It is particularly important to add value to that aspect. And so Yeah, I place a lot of focus on this, and for example, one of our key platform companies, we hired a CFO. This person was truly a CFO. He had spent 20 years in in different private equity situations where he assisted in driving growth through the things I just referred to. He is now our CEO of that entity. We've just hired a really pretty experienced controller, but this person has done all the things that I've referred to, which is resetting the thesis, building a team, understanding the integration of all the functions of a business, and is attracting our next add-ons to this portfolio investment. So in that particular case, the CFO has really emerged as our CEO.
That is a common path we see. We like to see it. I'm always a fan of the accountants doing that. So that's my own personal bias. Jerry, James, any other stories from some of your portfolio companies?
Yeah, I'll use a personal one, and that was not necessarily when I was at a private equity, but most recently as a CEO of a private equity company, and Jim, my CFO. And I don't know if I would characterize it as contributing to growth, but I would say 100% contributing creating enterprise value. And that enterprise value was based underneath 5 or 6 different metrics from where we were at one point in time to what we want to do in 3 years. And that was, he was my right-hand person in order to, we tripled the size of the company. Half of that came from organic growth, half of it came from inorganic. And as you're doing that, you have to have the synergies. He drove all the synergies and made sure that, we're going to get those margins. Always made sure that, so I said, I characterize it as the one that's overlooking the KPIs and the one that's always stepping in my office that says, look, our sales leader here is, we can't do this deal, right? This is how it's going to erode us, or, we can't hire these individuals here, based on the KPI. So I would say, a good CFO that is in the weeds, that's always presenting you in readable formats around, here's our KPIs, and this is what will help us, and this is what will hurt us.
Yeah, I would just add, I definitely agree with Jerry on that point. It's really all about maximizing enterprise value. One example I can think of with one of our portfolio companies is, versus optimizing and growing revenues, I think it's sometimes as important to manage costs appropriately. One of our CFOs, it's in a regulated utility business where they have to go file rate cases with the commissions, the Texas Railroad Commission, to set their revenues. The company had historically just filed things a certain way, did their accounting a certain way, and included certain expenses that were supposed to be included and what they had always included in their rate cases. And this CFO went in and just went line item by line item and looked at every single one of their expenses that they had incurred over the years, every single one of their capital expenditure and incurred over the years, and then did the research and looked into exactly what previous companies have been able to incorporate into that rate case, and really just threw the kitchen sink into it to be able to any expense that was reasonably able to justify lumping into that rate case, he went and did. And that was something that the CEO had not previously done because he was familiar with the way of just doing business with the Railroad Commission as it typically been done. And we think that's going to lead to a significant increase in our revenues on the back end of that, which is going to optimize our EBITDA and our enterprise values.
Very cool. So I think we only have about 5 more minutes here. We're going to end with one last question that I need all you private equity guys to get your crystal ball out. In the new world, new COVID world, all the stuff that's definitely impacting industries unequally across the landscape. I just like to hear from each one of you guys from the private equity space. What areas, what industries or sectors do you expect to see growth and new investments, over the next 1 to 3 years? Jerry, you want to start on that one, then we'll work our way around?
Yeah, I mean, I think it's, I mean, a good indication of it's going to be, well, what's happened over the past 3 to 6 months, and how does that affect an individual company's balance sheets and income statements? So, I mean, it's hard to argue that technology or technology-enabled businesses aren't the way of the future, right? Because they're standing well underneath it. And maybe that's a bias because that's where I spend, 100% of my time, associated with that. I mean, areas that you'd have concern, of course, is what's going to be the aftermath of the real estate market and the hospitality market, the transportation market that's associated with that. So from myself, it's when you look at growth in the new investments, I would better characterize it is where there's visibility into some type of recurring revenue or subscription based, and then doesn't necessarily have to be technology, because there's the easy metrics there is understanding what your churn is and what your margins are, and can that sustain.
Lou, what are you guys looking for these days?
Well, notwithstanding that we're in the hardcore asset business, I would lean toward Jerry's comment that technology and healthcare, I think, are two sectors that are continue to expand and explode to the extent that they have a unique aspect to surface and efficiency and the adapting society. However, I do believe certainly in our businesses, in industrial services and the hard asset businesses, to the extent that there is a service element and a strong view of how working capital is managed efficiently and service a diverse group of customers and not dedicated to one sector, for example, energy or finance, financial services, or a particular industry segment. So, but the top two I would select would be technology and healthcare.
James, I know you guys are doing a little different. What do you think?
Yeah, I think in a post-COVID world, and I think this applies really across every industry out there, but I just think there's going to be an increased focus on sustainability and ESG. Our fund is obviously focused on that, but we think that just that concept and that theme really applies across every industry. It's not about all going from fossil fuels to renewables, but every industry, even the industrial services industry, for example, we just bought a business that cleans storage tanks, and you say, well, how is that a trend towards sustainability? And they just do it in a slightly different way, where they don't have to open the top of the tank so emissions get out, and they don't have to landfill any of the waste that's inside the tank because they found a way to chemically recycle it. Even in other industries, like I remember I was in investment banking for a couple of years when I started my career, and back then they used to fly analysts out from like New York to London to like deliver like pitch books for like a meeting. And the analysts will literally fly there, deliver the books, like not even go to the meeting, and then just fly back, right? And so I think in that industry, I think you'll see kind of less unneeded travel. And I think every business out there, every industry going forward, is going to start thinking about how do we contribute to sustainability? How do we make our own business model ESG perspective still be as efficient in operating our business as we can? So I think sustainability is going to be a key trend for everybody going forward.
I love it. You talk to 3 different private equity guys, you get 3 different industries. It always entertains me. There's growth everywhere. Just got to go find it, what someone said once. So, hey, I just want to wrap up here. I would really appreciate Lou, Jerry, James, taking your time, taking your insights. I think all 3 of these individuals are going to stick around for some of the breakout rooms and network rooms. So I'm not quite sure how they're going to do that. Also want to call out the last polling question here. Just to make sure everyone gets their CPE. Once again, thank you guys. I really appreciate your insights into this, helping this group see into the private equity world for those that may not be experienced with it. Nancy, do I turn it over to you? I'm not quite sure where we need to go next.
Thank you very much, Kenny. I appreciate it. And we have the last poll up on the screen, and I'll leave that up there for a while, just so that we're ready. I do believe we're ready in the main room.
Thank you, Kenny, for putting together such a great program for us on private equity. I want to thank all of our speakers, Kenny Wilkes, Lori Mathiel, Terry Colston from Moss Adams, Lou Grabowski from Juniper Capital, James Wang from Era Partners, Todd Way of Vincent and Elkins, Jerry Dolinsky of Marlin Equity Partners. Thanks to all of you. I didn't get to introduce Kenny when we first started out. I was supposed to do a quick introduction, but he is a partner with Moss Adams, which is one of our great sponsors. I also want to thank Tom Beidel and Jay Marquis for putting the program together. And I want to apologize a little bit for some of the people who are trying to get on the webinar portion of this. There were some technical problems. I hope you all ended up getting on. Don't forget, if you're here in person, your CPE is in your badge. You need to sign and check on that. And I wanted to tell you kind of what's going to happen with the networking. For the people who are in person, the networking is going to be out on the lawn outside here to the west of where we are. Please be safe. And the virtual breakout rooms are going to be hosted by sponsors. So just stay on and you will be placed into a room. You don't need to do anything. And about 20 minutes into it, you'll also be randomly shuffled into a separate room. I appreciate our sponsors hosting those sites. Just hitting the time frame real quick. The networking is going to be from 5:15 to 6 o'clock to 6:30. We have dinner, so everyone will be back here who's in person. People who are virtual will just be off. Hopefully you'll get to enjoy the dinner that FEI provided if you signed up in time. And then the keynote speaker will be 6:30 to 7:30. So I will release everybody out to the social period. Thank you.